all I started doing was then dividing every chart by the total global liquidity, or even the Fed balance sheet, or M2, whichever you want to use, right? And you found that the S&P goes sideways, gold goes sideways, real estate goes sideways, roughly. The NASDAQ goes up, and Bitcoin does that. Okay, so now you've got two assets, only two assets in the world that outperform the debasement. Tech stocks, we get it, tomorrow is more digital than today. Of course they're going to do well over time. And second is Bitcoin, so you divide one by the other, and the NASDAQ's down 99.97% versus Bitcoin. And once you see it like that, and you realize it's all driven by one cycle, which is one dominant factor of debasement, then it makes it really easy, which is just own the one asset that outperforms. And because they're all correlated. And risk adjusted, it's by far the most superior asset we've ever been given on a risk adjusted basis. So just do that. Everybody's future self is getting poorer because every year you can't afford as much assets. And so therefore, all of these millennials are just finding this in front of them that they can't buy a house anymore. They can buy less of the S&P. It's just a really messy, ugly situation.
Raoul Pal begins by addressing the driving force behind the current economic environment, currency debasement. He explains that in a world where currencies are continually losing value, investors face a steep hurdle rate approximately 12% when considering 8% currency debasement and 3% inflation. This means that unless an investment returns at least 12%, it fails to generate real wealth. Pal points out that this dynamic is why many traditional investments, such as the S&P 500, are no longer sufficient to build wealth. While the S&P 500 has historically provided returns around 12%, these gains merely keep pace with debasement, leaving investors at a standstill. This explains why many millennials, despite diligently investing in their 401ks, find themselves unable to afford significant assets like homes. Their investments are only matching, not outpacing, the loss of currency value. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
But if everything is being driven by this one dominant factor, which is debasement of currency, and your hurdle rate is, let's say, 8% debasement plus 3% inflation or something, 11%, call it 12% for easy maths, on a globalized level. So unless you're making 12% returns, you're not going anywhere. Then at Exponential Age Asset Management, the asset management firm that I co-founded, we have this table of all of the different assets. And basically, the S&P is about 12%. So owning equities, which is why all of the millennials who have 401ks and they put it in the S&P still can't afford a house because they're just matching the debasement. They're not beating it, right? So they're not getting paid for locking up money for extended periods of time. The NASDAQ, about 17% a year since 2011. Okay, so the NASDAQ, because it's a secular technology trend, outperforms. Makes sense. And then you've got the bizarro world of Bitcoin, which is 150%. Gold actually doesn't beat it. Gold's about 8 or 7. So it's you're actually worse off in gold than you are owning the S&P 500, which is why that ratio keeps moving. So Bitcoin makes such a dramatic difference. So all I started doing was then dividing every chart by the total global liquidity, or even the Fed balance sheet, or M2, whichever you want to use, right? And you found that the S&P goes sideways, gold goes sideways, real estate goes sideways, roughly. The NASDAQ goes up, and Bitcoin does that. Okay, so now you've got two assets, only two assets in the world that outperform the debasement. Tech stocks, we get it, tomorrow is more digital than today. Of course they're going to do well over time. And second is Bitcoin. So you divide one by the other, and the NASDAQ's down 99.97% versus Bitcoin. And once you see it like that, and you realize it's all driven by one cycle, which is one dominant factor of debasement, then it makes it really easy, which is just own the one asset that outperforms.
Yeah.
And because they're all correlated. And risk adjusted, it's by far the most superior asset we've ever been given on a risk adjusted basis. So just do that. Yeah, particularly if a bear market lasts longer than a year. So a year they can pretty much buffer as long as it's not too big. But if it grinds on for 2 or 3 years, you're right. The tax revenues don't add up. People get tipped out of jobs, so there's less other revenues coming. So it's cap gains, it's earnings, it's household income, the whole lot. And then before you know it, again, exactly the same issue. I hadn't really thought of it that way, but that makes total sense. You just can't have a long-term recession right now because everything is resting on it. For each 1.5% of earnings growth, assets are going up by 10%. So each year, you can buy less and less assets. Now, what is an asset? An asset is future deferred consumption, whether it's for yourself in retirement or your kids or whatever it is. But it's a saving of wealth that needs to grow to compensate for how long it's locked up for, and therefore your future self is protected. It's your wealth, and if it grows enough, you make a lot of money. But the issue is, everybody's future self is getting poorer because every year you can't afford as much assets. Right. And so therefore, all of these millennials are just finding this in front of them that they can't buy a house anymore. They can buy less of the S&P. It's just a really messy, ugly situation. Well, most people tend to err towards it's all going to blow up. I'm like, show me how. If you can debase a currency, a global reserve currency, how's the assets going to collapse? You can't. It's like the Venezuelan stock market goes a lot in Bolivar terms. In dollar terms, it goes down.
Right. That's
debasement. So I'm like, I don't think that is the outcome. What I actually think of the outcome is, remember that magic formula, GDP growth plus productivity growth plus debt growth. Right, debt growth is stopped. It's just servicing of old debts. Population growth, we know, is negative out for 30 years. And what is the answer? AI and robots. They're infinite humans. And productivity, what is productivity? Productivity really is how much output per kilojoule of energy. Now, think of that as electricity costs. If you then think about, and a lot of people are like, the Europeans, they're nuts, look what they're doing with this green energy, they're wasting money. They're not. Their entire job is to lower the cost of electricity, because that is the only way they can pick up GDP, because it creates the multiplier to productivity. They don't have the tech industry in the same way, but they have, them and China are the big pushers of renewables. So the cost of renewables has been collapsing over time. It's down 99% over the last 15 years. So as it's getting cheaper and cheaper, eventually you can scale it enough that you will change productivity. On the other hand, you've got Japan, China, the US using AI and robotics, which creates infinite people. Now, if you've got infinite people, you kind of break GDP. I call it the economic singularity. You get to some point where GDP doesn't mean anything anymore. What does any of this mean? So if you've got productivity going up because of energy costs, and you've got infinite humans, or what, humans in inverted commas, then that changes everything. Now, people are going to say, oh, Raoul, you're smoking crack, this is all weird. This is exactly what happened after World War II.
Lyn Alden highlights the delicate balancing act that central banks face. By raising interest rates, they can strengthen their currency and curb borrowing, which can lead to economic softness. However, larger fiscal deficits can counteract these efforts by stimulating the economy and potentially driving inflation. This creates a complex dynamic, akin to driving a car while simultaneously pressing the gas and brake pedals. Lyn Alden also points out that governments are increasingly relying on short-term debt instruments, such as T-bills, to fund themselves. While this approach helps manage liquidity in the market, it also increases the risk associated with shorter debt durations, which could lead to greater volatility in the future.
So when we look at the Fed, first of all, by raising rates, it does two main things. One, it makes the currency more attractive for foreign holders, so it strengthens the currency, all else being equal. And two, it puts more pressure on borrowers, so they're less likely to borrow, which means less money creation from the private sector, and just more chance of economic softness and weakening. On the other hand, the fiscal deficits, generally larger deficits, are stimulating for the economy and with the offset of being potentially inflationary for the economy, especially if down the road those deficits become monetized again. And so it's kind of like trying to drive a car while also, you're putting the gas and the brake at the same time, which is kind of how the fiscal and the Fed are kind of acting with each other. And then the Treasury has other tools. So in addition to just the deficit itself being stimulating and inflationary, they also can shorten the average duration of the debt that they issue. And what that does, basically a T-bill is very similar to cash, right? There's virtually no price risk, and you get the full faith and credit of the U.S. in nominal terms. Whereas if you have a long duration treasury, you basically have a lot of volatility and risk in case that interest rates go up in the future, including kind of that long end. And so by introducing more T-bills, they basically are issuing lower risk type of debt. And they're also, in this case, able to pull money out of the reverse repos. So there's a lot of money market funds, and there haven't been enough T-bills to accommodate that demand. And so what the Fed doesn't want to happen is for all that excess demand to push T-bill yields below their interest rate target, because that would defeat the purpose of trying to be hawkish, which they're trying to do. So what they do instead is they open the reverse repo facility and say, you can put extra cash here at this rate. So it makes it so that they don't drive T-bill yields below the target rate. But over time, as more and more T-bills come out, those money market funds can go and buy T-bills again. And so by doing that, it kind of keeps the market liquid. There's not like cash being drawn out from bank reserves and things like that, because as it's being drawn out, the repo facility is kind of putting cash back in. But the downside is that the government is funding itself with shorter average duration because of that. And it's kind of, looks unusual. They kind of have a target of how much of their debt should be T-bills, and they're currently over that target. Now, the somewhat unintuitive thing is that their average debt duration hasn't really gone down too much, because they also have issued a lot on the very long end in recent years, and so their average debt duration is not particularly out of normal. Just specifically their rate of very short-term debt is higher than normal.
Lyn Alden insights offer a sobering view of the current investment landscape. In a world driven by currency debasement and rapid technological change, traditional assets like stocks and real estate may no longer suffice to build and preserve wealth. Instead, investors must look to assets that can consistently outperform these forces, namely technology stocks and Bitcoin. As the global economy continues to evolve, understanding these dynamics will be crucial for anyone looking to secure their financial future in an increasingly uncertain world. Whether you're a seasoned investor or just starting, please like and subscribe my channel.